We've got Kumar Rachapudi joining us on the show now. He joins us from Singapore. Kumar is Emerging Markets Asia Fixed Income Strategist at Barclays Capital. Now, Kumar, to begin with, just focusing on the fixed income markets, would you agree with the assessment that foreign funds are going to view Asian bonds more as a structural rather than a tactical allocation of money in the months to come?
Definitely yes. I think most Western investors, especially the asset managers, have been structurally underinvested in Asian assets. The last couple of years have definitely provided them with an opportunity to increase these allocations, right? And we do expect these structural flows to continue going forward, especially as the rates in the developed world remain lower for longer. That said, there are near-term risks in some of the markets, like let us say Indonesia, where already foreign holdings are a significant share of total outstandings. So cyclically, we could see a pullback, but the structural flows from Western world to Asian assets, particularly the bond markets, will continue.
Right. Give us a sense then on how you see within Asia which sovereign bonds look the most attractive to foreign investors.
In terms of dollar bonds, we do like 10-year Indonesian bonds. The issue earlier this week was well received in our opinion. The curve is inverted in the 10s, 30s space, but I think the 10-year bonds should remain supported. Philippine GPNs also should do well given our positive view on the currency. In terms of the local currency bonds, safe haven assets like China, Korea should do well.
Now, Kumar, despite the foreign investment caps that presently exist on Indian government bonds, we understand there's still a fair amount of interest among funds in Indian government debt. But tell us what the key concerns of these investors are.
Right. I think given the high yield of Indian bonds these days, there is ample interest out there from foreign investors. But the key question for these investors comes from the high fiscal deficit as well as the high current account deficit in India. Look at the way dollar INR is moving, and that's mostly because of the high current account deficit. At the same time, the government spending policies also means that fiscal deficit stays at highs. What matters for investors going forward is the way the government shapes up its fiscal policies and contains subsidies. Once these subsidies containment is in place and fiscal deficit moves towards a sustainably lower path, we do think that FII investments into Indian bond markets will continue going forward.
Right. Give us a sense then on the liquidity situation in the Indian financial system. That is still a bit of a challenge. Aside of the increase in the MSF cushion to banks, do you expect that the RBI will lower CRR in the coming months?
Well, the liquidity situation in our view is such that it will be within the comfort range of the RBI. The RBI stated that its comfort range will be at 1% of the deposit base as its comfort zone. Liquidity deficit, in our view, will be well within that range. Unless, of course, dollar INR moves sharply higher and the RBI has to intervene in the FX market withdrawing INR liquidity. Barring that, liquidity will be in a comfortable zone, definitely until September, beyond which there is a need for liquidity injection from the RBI because currency in circulation will increase sharply due to festive season and that will drain out liquidity. What will the RBI do going forward? We do expect the RBI to inject liquidity after September mostly by open market operations rather than a CRR cut. CRR is already quite low compared to historical levels, and we do think that bulk of the liquidity injection will come from open market purchases of bonds.
Right. Now, Kumar, also on the rates front, how much more do you see the Reserve Bank lowering the repo rate in the current financial year?
Well, we saw that the RBI delivered a surprise 50 basis point cut earlier this week. Most analysts, including us, were expecting 25 basis points. But we have been calling for 100 to 125 basis point of cuts for this fiscal year, and we still stick to that view. We do think that there is scope for further monetary easing in India during this fiscal year, given our inflation and growth trajectories. That said, in the next couple of months, the RBI would probably follow a wait-and-watch approach, which means that it may be on hold in the next 1 or 2 policy meetings. But we do see that there is scope for at least 50 to 75 basis points of more of cuts in this fiscal year, i.e. ending March 2013.
Right, the bond markets have been witnessing a fair bit of volatility in the past few months. Has this made Asia high-yield bonds particularly attractive to investors?
Well, Asian bond markets have been exhibiting volatility for a variety of reasons. Let us say for India, for example, has been exhibiting volatility because of domestic concerns, i.e. excess supply, whereas in bond markets elsewhere have been exhibiting range-bound price movements. Let us take Indonesia, for example. The bond yields have been stable for the last month or so. Asia as a whole, we do think that bond markets will be supported. There could be cyclical reasons why we are not favoring certain bonds, like let us say India or even front-end Indonesian bonds at this moment. But the structural inflows into Asian bond markets will mean that going ahead in a medium term, we do think bonds will be well supported.
Also, Kumar, spreads on Asian high-yield bonds are at fairly elevated levels. Are you witnessing defaults in the Asia region, or is there concern among investors over potential defaults?
Well, while spreads on high-yield bonds are definitely elevated, we do not see any scope or we do not see material risk arising from this. Spreads are high given the tight liquidity conditions, especially in countries like China and India. But given that policymakers do realize this fact and are willing to provide the necessary liquidity out there, we do think that spreads will compress over the medium term. For now, of course, we remain cautious on high yielders, and we do prefer the high grade investments in the near term.
Right, and finally, Kumar, given that inflation has re-emerged as a threat to economies across Asia, do you believe linker issues could find favor with investors in the region, and why do you believe that the product hasn't taken off as much in Asia as it has in the West?
Well, yes, inflation has emerged as a concern in Asia, particularly given the still elevated oil prices. Now, if you look at the linker markets in Asia, there are only 2 markets, i.e. Thailand and Korea, where there is a bit of issuance out there. The rest of the markets, we do not have outstanding issuance. The main reason for limited investor interest is the lack of sufficient outstanding bonds, which is kind of a chicken and egg problem actually. But both Thailand and Korea are issuing more going forward, and once there is a threshold outstanding of bonds available, there is enough secondary market trading which will happen, and that will in turn increase interest from Western money managers in Asian linker products. For now, of course, these linkers are confined with domestic investors and Western investors who buy them in the primary auctions, and there is very limited secondary liquidity available, which hampers further development in the near term. Once these outstandings improve, we do see the scope for, we do see interest in linker markets increasing quite rapidly going forward.